Mark your calendars for June 12th, guys, because we're gearing up for what is, without a doubt, the most highly anticipated, superlative-filled financial event of our lifetimes, the SpaceX IPO. Trading under the symbol SPXX, this is not just another tech company going public. It's an event that has the entire financial world basically holding its breath, caught somewhere between unprecedented market hype and the brutal mechanical reality of how public offerings actually work. So in today's explainer, we're going to break down exactly what is about to happen.
I mean, just look at this number, $2 trillion. That is the astronomical estimated valuation for SpaceX as it prepares to hit the public markets. Brought to us by the richest man on the planet, this massive valuation carries some serious historical weight. If expectations hold, the sheer value of SpaceX could literally make Elon Musk history's very first trillionaire. The expectations surrounding this company are off the charts, but as we're about to see, a revolutionary company doesn't always equal a guaranteed early payday for retail investors.
Okay, let's dive into this. Here is our roadmap for today's explainer. First, the hottest IPO in history. Second, market timing is everything. Third, the hype versus reality paradox. Fourth, the SpaceX demand squeeze. Fifth, insider lockups explained. And finally, number 6, what to watch for.
Starting with Section 1, the hottest IPO in history, anticipation in the space sector.
The psychological thrill right now is so immense that we're seeing proxy stocks and sector funds absolutely surging, just waiting for June 12th. Take the UFO ETF, for example. It tracks the space and rocket sector, right? Since its launch in 2019, it basically stumbled around and did a whole lot of nothing for years. But right around the middle of 2024, it suddenly found its sea legs. Why? Well, it was rallying purely on the anticipation of SpaceX. We're also seeing related companies like ASTS, PL, and RKL flying higher. The market is aggressively positioning itself for this SpaceX halo effect, basically buying up proxies to capture a piece of the excitement before the main event even begins.
Moving right along to Section 2, market timing is everything, the historical precedents.
You know, broader market context dictates early stock performance more than almost any other factor out there. Let's look at some history. In 1990, Cisco came out in a crummy, super cheap market. The context stunk, but their growth prospects were terrific, and insider selling was minimal. The result? A nickel stock surged to $50 over the decade. Now look at Blackstone in 2007. Long-term, Blackstone has been a sensationally successful stock, but it IPO'd in a very, very expensive market. Its initial reaction? It lost about 90% of its value. It was an absolute dog early on. And check out Rivian in 2021. They launched during that post-COVID liquidity boom, fueled by massive hype around electric vehicles. Despite all that excitement, a harsh market correction in 2022 wiped out about 95% of its value. So as you can see, the broader market context is everything.
And this brings us to a really fascinating paradox. As the source material points out, the best time to come out with an IPO is in a way kind of the worst time for people to get into it. Think about it. A company obviously wants to go public when the market is high and people are super excited, right? That maximizes the cash they can raise. But for you, the retail buyer, that means you're buying at peak expense. And right now, SpaceX is coming out during a market where Buffett indicators, long-term trend lines, and PE ratios are actually exceeding the levels we saw during the internet and housing bubbles. The market as a whole is exceptionally expensive right now.
All right, Section 3, the hype versus reality paradox, the tech titan divergence. Let's consider the vastly different early realities of two massive tech titans. Google, back in 2004, launched into a battered market still reeling from the dot-com collapse. Tech stocks were cheap. Google started going up and basically never looks back. A day-one buyer practically never saw a single penny of loss. Now compare that to Meta, or Facebook, in 2012. The market wasn't particularly high or low, but the sheer obsessive public hype was deafening. Do you guys remember CNBC anchors literally wearing hoodies on air as an homage to Mark Zuckerberg? The stock came out in the mid-40s and then plunged into the teens just months later. The hype caused this artificial price inflation that absolutely crushed early retail investors, even though, long-term, Meta obviously became a giant.
Now, what's really interesting about this slide is how the recent IPO of the semiconductor firm CBRS perfectly illustrates this pricing mirage in real time. Look at this. The original target price to the investment bankers was $115, but because semiconductors are extremely hot right now, the hype drove the bank price up to $185. But then, when it actually opened to the public, insane retail demand pushed the opening trade to almost $385. Retail investors paid nearly 4 times the original target on day one. And what happened? Well, in just a couple of weeks, the stock crashed 40%. The public will pay whatever demand requires in the moment, for sure, but gravity always takes over.
Which brings us to Section 4, the SpaceX demand squeeze, the mechanics of the push.
You see, SpaceX isn't just relying on retail hype. The financial plumbing is actually being rigged in its favor. Rule changes dictate that massive ETFs and index funds are literally required to buy SpaceX stock early in its existence. This creates a really steady, massive base of passive demand. This is what we call the push. It basically creates a mandatory, elevated floor for the stock price right out of the gate, providing a structural reason why the stock might surge and stay elevated, completely independent of how many regular everyday people are buying it.
Well, let's look at the flip side in Section 5. Insider lockups explained, the mechanics of the pull.
So what exactly is an insider lockup? Well, it's a complex ladder of liquidation dates, often contingent on how well the stock performs, that legally determines exactly when company insiders are permitted to sell their shares. And why does this matter to us? Because with the $2 trillion valuation, you have thousands of insiders holding shares who are going to wake up fantastically wealthy. When they are finally allowed to hit that sell button to convert those shares to cash, hundreds of millions of dollars in supply will suddenly flood the market.
And this brilliantly illustrates the timeline we're looking at. For SpaceX, the lockup expiration isn't just one day. It's a rolling ladder. It begins in August, specifically the second trading day after their first earnings release. That's a pretty big chunk. Then you see these incremental unlocks rolling through day 70, 90, 105, and 120. But the absolute crucial point on this timeline is November. This is the second trading day post Q2 earnings, and guys, it is the monster unlock. This is when the largest block of insiders will get the green light to sell.
So the stock's first few months are essentially going to be a heavyweight fight between the push and the pull. In one corner, you've got the push, the mandatory required purchases from massive ETFs combined with the blind, fever-pitch retail hype of investors just wanting a piece of Elon Musk's empire. In the other corner, you have the pull. Newly rich insiders facing staggered lockup expirations, super eager to convert their paper wealth into hard cash, and they're selling into an exceptionally highly valued market. How these two forces balance out will ultimately dictate the brutal reality of the SpaceX stock price.
Finally, Section 6, what to watch for, navigating June 12th.
Okay, so here is your reality checklist for the big day. First, expect absolute mayhem on day one. Seriously, be prepared for a CBRS-style markup where the price the public pays at open is wildly disconnected from the bank price. Second, remember Blackstone and Meta? Great, world-changing companies can have terrible stock performance in their early months if the hype overinflates the entry point. Third, never ignore the broader market context. We are sitting at historic bubble-level valuations right now. And finally, if you want to see where the dust really settles, wait for that November monster lockup expiration. Only then will we see how the stock handles massive insider selling.
The chatter over the next few weeks is going to be absolutely deafening. But by understanding the mechanics of market timing, ETF mandates, and insider lockups, you can actually see past the noise. So as we approach this historic launch, I want to leave you with this provocative thought to ponder. On June 12th, when you look at that ticker symbol, are you buying the underlying mechanics of the company, or are you just buying the hype? Thanks for joining me on this explainer, guys. Keep your eyes on the data, and good luck out there.